In this video, I'll talk about why markets stop fearing inflation. Don't forget to subscribe. Let's head into it. The media screams, but the market is unfazed. Pick up your paper carefully this week. It's screaming at you. It's screaming that inflation is about to hit hard. The media experts are wrong. This will become clear over the next few months as things settle down. Still, there is a real danger here if inflation is caused, at least in part, by an increase in the public's expectations about inflation. Well then, these headlines are certainly doing their best to push the process along. The symptoms of the media's unhingement are everywhere. Some journalists are so taken with this narrative that their analysis become decalibrated from the topic and stray into statistical zones that have nothing to do with the inflation per se. Others are so determined to make their point, they won't balk at a little disingenuous exaggeration. One analyst has tortured the data to produce the misleading conclusion that inflation has now reached a shockingly high annual rate of 8.2%. In a subsequent editorial, the journal went even further into the digital neverland to make its case, lamenting the rising cost of non-fungible tokens, whatever those actually are. But we do know what they are not. Bitcoins and NFTs are not part of the market basket tracked by the Bureau of Labor Statistics. In fact, Bitcoin is not a consumer good at all. If it's anything, it's an asset, like a treasury bond or a gold ingot. Assets are never included in the inflation calculation of consumer inflation for the simple reason that they may appreciate or depreciate, but they're not consumed. Do we expect to see inflation adjusted downward when Elon Musk's comments cause the next big dip in Bitcoin? None of this has anything to do with inflation. The fact that Tesla stock is up 700% in the last year may have considerable significance, but it doesn't signify consumer inflation. The market response is not news that inflation is running hot. The May Consumer Price Index spike of over 5% was the highest since 2008. Strip out food and energy prices from that inflation print, and it was the highest inflation reading since January 1992. Producer prices, meanwhile, rose at their fastest pace in over a decade. And according to a Federal Reserve Bank of New York survey, consumers' fears about inflation are at the record. A good question then, why is the S&P 500 index setting new records? The Dow hanging near, if now slightly below a post-pandemic rally record, and the Nasdaq coming off a recent 7-day winning streak right before the Fed's meeting concluded on Wednesday. All three major stock market indices are now between roughly 90% to over 110% above their pandemic lows. For Nick Colas, co-founder of DataTrek Research, all the comparisons between current inflation numbers and records from the past are interesting for market historians, but less relevant to the stock market outlook. Stocks went into the Fed meeting treading water on Wednesday before the open, and then dropped in the afternoon when the Fed revealed a slightly more hawkish stance on raising rates in 2023. And commentary from Chairperson Jerome Powell has more attuned to inflation risk, even as the central bank continued to message that inflation was transitory. The bond market, the reason for his bullish take amid the inflation fears, and the number he says that is more important to watch the CPI, the bond market. It's a signaling patience. Even with a hot inflation print, treasury yields remain low. Yes, the inflation numbers can be real, and a valid concerns for the bears, especially when they point to prices for homes and rentals. But market historians should also note that the bond market has a history of being slow to react to inflation trends. Cautious on stocks, not panicky on inflation. Yields have retreated from March highs. That has helped lift the S&P to a new all-time record. While markets can go through short-term periods of panic related to bonds and stocks, the shortest term being the tendency of stocks to drop during Powell post-Fed meeting commentary. The bond market often takes a long time to really catch up to inflation. Historians can look at every CPI going back to the 1950s if they'd like, but Colas noted that the period he looks to right now is when the US was coming off the last major period of inflation that ended the 1980s and saw inflation decline from double-digit percentages to 2%. It took the treasury bond market 20 years to accept that inflation had been beaten in the US. In his opinion, the treasury market is a show-me market and wants to see inflation go up or down for a long time before it reprices. High inflation this year says nothing about the future, and before the pandemic, because we had such low inflation, the bond market will need a lot of proof before it says inflation is rising again. The market and outside forces. The stock market arena is a very volatile place. From one day to the next, one never knows exactly what's going to happen to the world at large and what repercussions those events could have. Just think back to how the markets reacted to the pandemic when it first hit. A landslide in stock prices, only to have the economy bounce back to record highs, despite millions of people remaining unemployed. As a result, inflation is currently running above previous expectations. In the US, prices rose by 4.2%, the most in September 2008, while in Canada, the CPI rose by 3.4%. It's the highest reading since September 2011, yet investors seem seem to have come to terms with this. The fear now appears to be how the US Federal Reserve will respond. Perhaps it may be fair to say that the market itself is not as unpredictable as the world at large. Generally speaking, prices react to news, depending whether that news is good or bad. Of course, can determine how the market will be affected. Some events almost have the predetermined outcome. For instance, when inflation is on the upswing, income stock prices generally decline. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. With that, I'll see you in the next video.